Okay, so in this section, we first look at the steps that involve in preparing statement cash flow and its basic format. And then we're going to walk through the steps in preparing the operating, investing, and financing section of the cash flow statement. Okay, so first of all, the steps in preparing statement of cash flow as following. It has a 4 steps. The first step is we need to calculate the net cash flow from operating activity and using information from income statement and change in the current asset and current liability section from the balance sheet. That's all you need, okay? That's the graph, remember? The graph that income statement and balance sheet, and this is cash flow statement, remember? And each section providing different sections, that's graph, okay? So this is just explain you in a narrative way. Okay, step 2. We want to determine the net cash flow from investing activity by analyzing the change of long-term assets, okay, in the balance sheet to understand this. And step 3 is we want to determine the net cash flow from financing activity by analyzing changing in long-term liability and stockholder equity section, all right? And step 4 is that we want to combine operating, investing, and financing activity, and then make sure that the total from these 3 activities equals the amount of reported in the balance sheet of this year versus last year, which is a changing in the cash. Okay. Okay. So let's look at the example. So this is the balance sheet, income statement balance sheet, and additional information for eGame Inc. So from net sales, as you can see, this is the income statement of the company end of the 2021. So they made $42,000. And then how do they do that? They had a net sale of 1 million, right? And then they have a cost of goods sold and the operating expenses, depreciation expenses, loss on the land, interest expenses, and tax expenses. So some of these expenses is non-cash related. And then I want to ask you which one, right? So for example, I'll give you example, depreciation expenses is not cash related, and loss on the sale of land is non-cash, right? So these two actually decrease the net sales and reduce, and hence that the net income is only 42,000. But if I want to translating this number back to cash base, I just ask you the question now, I will give you an answer later. So if we want to transfer back to cash base, should we add in the back the depreciation expenses and also add in back the loss of the sales of the land, right? Okay, yes or no, we will figure out later. Just give you a hint. Okay, and then this is the balance sheet, right? Balance sheet of the e-games. So therefore, they are very nice. They give us the 2 years and the most recent year on the left-hand side. So, and then there's a column is telling us whether it's increasing or decreasing. For example, cash, they are increased $14,000, and the accounts receivable is increasing for $7,000. Inventory is increasing for decreasing for $10,000, and the prepaid rent is increasing for $2,000. So on and so forth. We find out that each line item on this balance sheet is indicated by at least the asset section, right, indicated by increasing, decreasing of the amount. Continually, we can see in the liability and the stockholder equity section of the balance sheet of games, we also wanted to notate, right, which line item is increasing or decreasing. Current liability, long-term liability, and stockholder equity. And we know that only these 2 sections contribute to the financing activity of the cash flow statement, right? So what are we going to do with the current liability? We said that this is going to be the operating section of the activity. And the long-term asset, the changing in this section, we believe is going to be the investing activity of the cash flow. And changing in this section is going to be the operating activity of the cash flow, right? Okay. So let's see. So and also besides that, there's more detailed information about the eGames. For example, they purchase a stock in internal corporation for 35,000. So basically, they are investing the Nintendo Corporation for $35,000, and they sold the land originally costing $10,000 only for $6,000. Hence, that resulted in a loss of sales of land. And 3, they purchased $20,000 equipment by issuing $20,000 of notes payable, which is due in 3 years, and no cash exchanged. And 4, issue the common stock for $5,000 cash. So they sell their common stock for $5,000 in cash. And 5, they declared and paid a cash dividend for $12,000. So what are we gonna do? Let's see. For the operating activity, we wanted to have 2 methods introduced. One is indirect method, one is direct method. So the difference between, they are very different between preparing the operating activity section for the cash flow statement. Why is that? So first of all, both methods reporting investing, financing, and non-cash activity. Okay. So the difference is that indirect method begin with net income, and then it's back out or add in the adjustment to net income to arrive at operating cash flow. And it's most cheap and most popular method that is used, okay, to preparing cash flow statements. And it's because it's easier and it's very less costly. However, direct method is basically you restate the income statement by using cash flow based accounting. In other words, you adjusting the items in the income statement to directly show the cash inflow and outflow from operation. So basically you scratch the whole book, throw it away, and then you're creating another book of accounting by using cash based accounting, creating a cash flow statement. If you use that, that's okay. Company also have to report the indirect methods as well. Okay. So basically, if you prepare direct method, that's okay, but you also have to show us the indirect method. Okay, let's look at this. Basic format for the statement of cash flow under the indirect method, and which this class only gonna cover indirect method. Okay, and because everybody using indirect method. So first of all, net cash flow from operating activity, net cash flow starting with the net income. And then we want to adjust and reconcile net income to a net cash flow from operating activities, right? So there's a lot of items we need to adjust. And then we get a number here is actually net cash flow from operating activity. And then also second category, cash flow from investing activity, is we are gonna figure it out from the section of the balance sheet section, the long-term asset section. And then we're gonna figure out the increasing, decreasing. Now we're gonna put it right here. The third section is cash flow from financing activity. This is also from balance sheet, but it's from long-term liability section plus all equity sections activity, right? And we prepare this number. And then we figure out the change of the cash, right? Net change of the cash. And then we add in the beginning balance of cash, and then we figure out the ending balance of the cash. Okay, so the key point here is that company choose between indirect method and direct method in reporting operating activity in the statement of cash flow. The indirect method begins with the net income and then lists adjustments to the net income in order to arrive at the operating cash flow, right? And direct method specifically listing various of cash inflow and outflow of operations. The investing and financing activity for both methods are exactly the same. So in other words, if you want to use indirect method, it starts with net income. And you're just adding and minusing and then getting the correct number. But for the direct method, this is indirect. For the direct method, you're basically saying that so the revenue has to be based on the cash revenue. And then cash expenses, cash a loss, all those things has to be restated, and then you get a number. Okay, so basically you rewrite an income statement by relisting the cash-based revenue, cash-based loss. But the net income here, remember, is not cash-based, not cash-based. It is accrue-based. Right? We record a transaction based on whether the economic transaction really happened. Hence that, for example, the depreciation expenses, there's no cash impact, but we still want to minus out from the revenue, right? And then, for example, if you receive the cash in advance from the customer, but you didn't provide services, what do? We do not record credit revenue and debit cash, right? We don't do that. We actually increasing liability, right? The deferred revenue transaction. So in this case, the indirect method is going to record this as not part of the net income, but the direct method will consider the deferred revenue as part of cash received as the revenue. So this is the difference between indirect and direct method. You might feel a little bit confusing now, but don't worry. You only need to focus on how to use the indirect method. When you're in the intermediate accounting class, we're going to detail talk about the line by line item difference between direct item and direct item. Okay. And then another takeaway from this is that basically the financing activity and investing activity under both methods looks the same. Exactly the same. Okay. Okay. So let's further preparing the operating activity. So the operating activity section of a cash flow statement using indirect method. So how we do that? Non-cash item is the first thing that we needed to adjust. So we want to convert, in our shell, we want to convert accrue-based accounting to cash-based accounting. So for example, the depreciation expenses is non-cash item, right? And also we wanted to adjust non-operating items because we are talking about the revenue and expenses related stuff, right? But if you actually, the net income, remember, including loss or gain from selling stuff, from selling long-term assets, right? Or retire long-term liabilities. Those things are not related to revenue and expenses. Hence, that we have to exclude it, those gains and losses from sale of assets. And the last item that we need to adjust to arrive in the operating activity section of the cash flow statement using indirect method is we need to adjust the changes in the current asset and current liability. So the mantra is, or the simplicity of it is that you're gonna the increase in the accounts receivable is amount of the revenue reported in the income statement, but not collected in cash yet. Hence, you want to minus the increase of the current asset, right? And then not in our shell, so the increase in the accounts payable is the amount of the expenses, right, reported in the income statement, but not paid yet, paid by the cash yet. Hence that if the increase, we're gonna plus the increase of current liability. Okay, so this is most important thing. So I want to repeat it again. So if you have increasing accounts receivables, is amount of revenue collected reported in the part of the net income items, right? Accrue-based net income in the income statement, but we haven't collecting cash. So the increasing of the accounts receivable account has to be subtracted from the cash flow statement. Okay, and then the increase in accounts payable is expenses reporting in the income statement, which is already deducted from the net income number, but we have not paid yet, right, by the cash. So therefore, we wanted to adding it up, the increase of current liability. Okay, if you have a problem with this now, don't worry. Let's continue. Look at this. So to adjusting the operating activity, there's three things that you needed to take care. Okay, the first thing is to reduce non-cash statement, non-cash item. So this is called. Oh, hold on. This is a non-cash item. You need to take out non-cash item from the net income, because net income including cash related and non-cash related revenue and expenses, right? So to preparing the cash flow statement of operating income, you have to take out non-cash, with pick out the non-cash items. Okay. Second, you needed to taking care of non-operating related item, non-operating. Right. So say loss of self-asset, gain of self-asset, they are all non-operating related items. And third thing is that you need to take care of the change of the balance sheet account in terms of current asset and current liability. Okay, so how do we do that? Third section. So since non-cash item of depreciation expenses is subtracted from net income, hence that for the cash flow statement we want to add it back. Same thing for the amortization expenses, it's non-cash item, but it was subtracted from net income, hence we want to add it back to cash flow statement. Okay, and then since the non-operating activities, non-operating items on the related to net income, we need to also pick it out to restate the cash flow from operating activity, right? So therefore, we need to get rid of everything related to non-operating. So if you reduce net income by loss, right? Remember, loss is reduced income, net income, so we will add it back. But if you have increased the net income by recognizing gain of the sale of the asset, we want to minus it out by taking it out. And the last section is that because the increase in current assets is considered as a revenue that has not been cashed, right? The revenue is being considered as an accounts receivable. So the increase in the current asset is kind of representing a decrease in cash flow. And then if you decrease in the current asset, means that are using cash, the revenue item or revenue generated related to current asset is liquidated, transformed into cash, and so we want to add it up. And then same thing, if you have borrowed new debt, right? So you recorded, say for example, debit salary expenses and crediting say current salary payable, right? So this expenses was subtracted from net income, but it didn't. Instead of paying cash, you generating a new payable. So this generating new payable is saving the cash. Hence that we want to increase the cash, right? We wanted to add in the up because this expenses was supposed to reduce net income by say $300. So this number is already reduced by the $300, but this expenses is not cash expenses yet. It actually be recorded into the liability account. Therefore, we save in another way means that to translate this number back to cash base, we have to add in that $300 up because it's increasing current liability. And then same thing, when there's a decrease in the current liability. That means we use cash to pay off the liability, such as we will debit the cash salary payable, credit in cash. So by journal this, you definitely have a decrease in current liability, and then your cash is also decreased. So therefore, you want to subtract it. So in order to correctly do this cash flow statement, I want you to remember, first of all, we want to add back non-cash items. Okay, change the color. So we want to add back all non-cash item. I want to be more specific, non-cash expenses. Okay, that's the first thing you need to do. This is the first section. Second section is that we want to reverse the gain and the losses related to non-operating items. What does that mean? If you have a gain, I want you to reverse that. Means that you're gonna subtract it. If you have a loss, I want you to reverse it. You have to add it. And then what do you do with what do you mean loss and gain? I mean, what I meant is loss on the sale of non-operating items. Okay. The third section simply is that if you have an increasing in current assets, that means that the cash supposed to increase in cash get occupied by increasing current asset. Hence that you need a decreasing, you need to minus that out. But when you have an increase in current liability, means that you're supposed to use cash. The supposed cash goes down, but it didn't. It's an increase. It's taken over by the form of an increase in current liability. In that case, you will add in cash because cash didn't sacrifice yet. And then, but when you have an increasing in current asset, that means cash paid for something. Hence that you have to minus it. Okay. So therefore, just remember, minus the increasing of current assets and plus the increasing of current liability. Okay. And then when it's decreasing is the other way around. So therefore, you get this way you can get the net cash flow from operating activity. We're going to give you an example here. So E-Games reporting a net income of 42,000. So that's your starting point. You're translating this number back to operating activity cash flow statement, cash flow balance, right? And the depreciation expenses. So this item for $9,000 is non-cash item. So for non-cash item, we want to add it back, right? Okay. So therefore, net income, we're adjusting reconcile net income to net cash flow from operating activity. So therefore, we're adding $9,000 back because this is non-cash item, right? Okay. Second, we're adjusting items as non-operating related. So what is non-operating related? It's things are not relevant, not related to revenue or expenses. This is called non-operating. So therefore, if the E-Game saying that they sold the land originally costing $10,000 for only $6,000, resulting $4,000 loss of sales of land, this is not their operating activity, right? This is not operating. Hence that this item has to be taken out. So therefore, I said reverse the loss. So therefore, you're going to add in the loss of $4,000. So common mistakes. Students sometimes are unsure whether to add or subtract the loss on the sale of the asset. Just remember that a loss is like an expenses for both reduce the net income, right? Treat a loss on the sale of asset like a depreciation expenses and add it back to the amount of net income. And similarly, a gain on the sale of long-term asset is opposite of the expenses. So we subtract that amount from net income to arrive at net cash flow from operating activity. So basically, you want to add a loss on sales of long-term assets. And you're going to minus the gain on sale of long-term assets. Okay, so the third one is increasing in current asset, we want to decreasing the cash. And decreasing current asset, we will increasing the cash. Why is that? And also increasing in current liability. So I want to say increasing in current asset, we want to reduce the cash. Decreasing current asset, we want to increase the cash. And then increasing in current liability, we want to increase in the cash. And decreasing in current liability, we want to decrease the cash. So example, current asset means the accounts receivable, right? Accounts receivable increase, you're going to reduce the cash. And the adjustment to operating activity decrease the cash. So I will give you a multiple example saying that when there's a decrease in salary payable, should we increasing or decreasing the cash? Answer increasing. Okay, so let's look at this. E-game accounts receivable received an increase in for $7,000 during a year, from $20,000 to $27,000. So therefore, we wanted to increase in accounts receivable become a decrease in cash statement. Okay, next one. So the inventory balance decreasing by $10,000 during the year. So decreasing in current asset means increasing in cash. Okay, so in other words, that this tells us that the company sold $10,000 of inventory that was not replaced, right? And this $10,000 reported as the cost of goods sold as expenses on the income statement, right? So basically, you debit cost of goods sold and credit inventory for $10,000, right? And then this cost of goods sold, remember, is to reduce the net income, right? And then, but that amount had not reflecting on the cash, right? To adjust our cash being greater by $10,000, we're adding the decrease in income inventory to the net income. So we want to add it back. Because you find that you have a decrease in your inventory account for $10,000, that means that you have not replaced the inventory. Means that you didn't pay cash to buy inventory to make sure the inventory account still stay the same. So you have not spent cash to make inventory account. Hold on. Sorry. So you haven't, let's look at to make the inventory account stay as before, right? So you find that there's an increase in, so you find that the inventory balance decrease. That means that the inventory in 2021 is smaller than 2020. So that means that something is sold and it didn't replace yet. So it says $10,000 here. So that means during this year, you must have had this transaction with cost of sold transaction credit inventory, right? And this has nothing to do with cash, right? No cash involved, no cash involved. But if you see here, this cost of goods sold is actually reduce the net income. So therefore, the net income should not be affected by this $10,000, right? You should add it back to $10,000. Okay. Okay. So prepaid rent increased for $2,000. How does that explain? So this means the company paid the $2,000 cash for an asset. So basically, prepaid rent and credit in cash, right? For which there is no corresponding expenses. So in here, there's nothing goes to the net income because this is an asset account, right? This is a plus asset. This is minus asset, right? So net income has not to do anything with this $42,000 has nothing to do with either of the accounts for this $2,000. But you have to minus it out because it increased. But in other words, the cash outflow to increase in the prepaid rent caused the cash to decrease, right? So you got to minus it by 2,000, but net income remained unaffected. So therefore, you need to record transactions that does not affect in the cash flows, the net income, but decreasing the cash. So therefore, increasing the prepaid rent to minus it. We subtract the increase in prepaid rent from the net income. Okay. So, and then also accounts payable decreased for $5,000. How do we deal with that? So this decrease of accounts payable indicates that the company paid, right? So the accounts payable for 2021 minus 2020 is actually decreased. So 2021's accounts payable is smaller than 2021's. 2020's for $5,000. So that means that the company actually paid for this. So basically, accounts payable for $5,000 and cash for $5,000. So in this transaction, you decrease liability and increase asset. There's nothing embedded in the net income, but this affects cash flow statement, cash, right? So therefore, you're gonna decrease in accounts payable. So you will minus the $5,000 out from the reconciliation. Okay. And then also, eGames interest payable increased for $10,000 during the year. So basically, you want to, as increase in interest payable, but basically you have interest expenses and credit the interest payable, right? So therefore, so this is $1,000, and this one goes to the net income, right? So this one is reduce the net income, but this one is increasing the liability. So the $1,000, this is not paid by cash, but it decreased the 42,000, right? But has nothing to do with the cash because you record under the interest payable account. In other words, the $1,000 increase in interest payable reduces net income because the interest expenses, right? But has no effect on cash. So in other words, there's no effect on cash. Therefore, we wanted to add it back, $1,000, right? Although it's embedded in $42,000, but it has no effect on the cash. So therefore, we added it back. It's reduced the $42,000 from some, maybe it was supposed to be $43,000, right? Because you record interest expenses, it becomes $42,000. But this extra $1,000 effect was not paid out by cash. It was recorded as the payable. Hence that the cash increased for $1,000. This reduction of $1,000 is non-cash related. Okay? So after that, you can see that decrease in tax payable, right? The income tax, the tax payable is $2,000 during the year. So there's a decrease. So therefore, in other words, the decrease in in tax payable indicate that the company paid $2,000, so tax payable and crediting cash for $2,000, and this is the minus liability and this is minus asset. So this has nothing to do with $42,000, but we need to also minus it out because it has a lot to do with cash decrease, right? So in other words, the cash outflow reduced the income tax payable caused cash to decreasing by $2,000, but the net income remained unaffected. To adjust for cash being lowered by $2,000, hence that we needed to minus $2,000 from net income. So at the end, we get $50,000. So if you wanted to summarize this, that we're adding back non-cash item. We're adding back non-operating loss, right? We minus increasing in current assets, okay? And we are adding back a decreasing current assets. And then we minus increasing current liability. We minus a decrease we minus increasing current asset. We minus decreasing current liability. We plus increasing in current liability. So if I were you, I would do this. Okay. So current assets, current liability, increasing or decreasing. Okay. So I always increase or decrease. Okay. So when the current asset is increasing, we minus it. When current asset is decreasing, we plus cash. We increasing cash balance. When current liability is increasing, we plus cash. When current liability is increasing, we minus cash. This is how I remember. Okay. Okay. So using the indirect method, we start with net income and adjusting the number for first of revenue and expenses items that do not affect the cash. And then 2, gain and losses that do not affect operating cash. And then 3, changing in current asset and current liability. Okay. So let's do this one. Which of following would be included as an adjustment for net income operating activity section of the statement of cash flow? Indirect method. A, depreciation expenses. B, purchase of a truck. C, issuing common stocks. D, payment of cash dividend. And this 2, we said is gonna be the financing activity, right? And purchase of a truck is gonna be investing activity. So therefore, depreciation expenses should add back to the operating activity because it's a non-cash item. Okay. Let's see, which of following items will be added back to the net income in the operating activity section of cash flow? Okay, gain on sale of piece of equipment. That this has to be adjusted in the operating section, but we want to minus it, right? Because this gain on the sale of the piece of equipment has to be excluded from the operating activity. And starting, since the net income is increased by this gain, right? Increased by the gain. So to translate into cash, the cash in the operating activity, we need to subtract this gain. So yes, so minus, right? So decrease in salary payable. So how does that work? So basically we debit salary payable, we credit cash. So there's a cash outflow, so we have to minus, right? So, but the question is which section is adding back? So add plus, right? So B is not right either. C, increasing and balancing an accounts payable. So basically we debit uh, interest expenses, let's say, and crediting accounts payable, right? So interest expenses is minus net income, and then this adding liability. Since the interest expenses is reducing net income, right? Hence that it, and also it did not associated with cash outflow, so we needed to adding this one back. In other way, remember current asset, current liability, draw the line. So increase and decrease. So when current asset is increased, we want minus it. When current liability is increasing, we want adding cash. So therefore, this one is correct, right? So increasing balance in accounts receivable. So basically increasing accounts receivable, we want to minus it. So this is minus. So the correct answer should be C, right? So why increasing a balance accounts receivable, such as it has to be decreasing cash flow? It's because when you make a sale, you debit accounts receivable, you credit sales, right? So this is increasing the net income, but there's no cash flow, cash impact. So therefore, the net income number should be, if you want to adjust net income to the cash, you have to minus the accounts receivable amount, right? Okay, so that's why. Increasing in current liabilities such as accounts payable or adding back to net income in operating activity section of the statement of cash flow to arrive at the net cash flow of operating activity. Okay, so now let's move on to how to prepare the investing activity section of cash flow statement. Investing activity is interesting, very simple. So we're increasing or decreasing investments. Okay, so increasing or decreasing the long-term assets is also part of the investing activity. And so such as what is the long-term asset, PP&E, right? Property, plant and equipment, and intangible asset. So if you're increasing, you will minus the cash flow, right? So if you increase, if you decrease these items, you will plus cash flow, right? Because you bought it. So let's say this one example. eGames purchased an investment for $35,000 for cash, sold the land originally costing for $10,000 only for $6,000, and purchased $20,000 equipment by issuing $20,000 notes payable. So in the cash flow statement of investing activity, what do we do? First of all, for purchase investment, we say you purchase something, you have a cash outflow. So you minus the cash. So you sell off the land. Remember, this one we split out from the operating activity, but it's gonna be stay on the investing activity section. That's the reason, because it's a long-term asset, right? We sell it, it's gonna be put here. So therefore, when you sell for $6,000 cash, we're adding the cash inflow. And then so there's a net cash flow from investing activities minus 29,000. You ask me, okay, what will happen to this item? Okay, this item we don't do anything because look, this is a significant financing investing activity without involving cash. Because look at the equipment is paid by the notes payable, right? So there's no cash involved. It's closed in the notes section. Okay, So cash transactions, inflow and outflow involving long-term asset and current investment are reported in the investing activity section of statement of cash flow. Typical investing activity including buying and selling, PP and E section, as well as making a collection of the loans. Okay. Which of following cash transaction would be included in the investing activity section of the statement of cash flow? Purchasing a building, absolutely. Obtaining a loan at the bank, the finance, right? Because you are getting a loan, you're getting money from a bank. I said anything related to bank and investors or financing activity. Issue common stock, financing activity. Selling goods cost operating activity, right? Okay, very good. So last one is preparing the financing activities of the cash flow statement. So first of all, we want to examine the change in long-term liability and stockholder equity accounts from the balance sheet. So, and then in nutshell is that the cash transaction with the company's creditor or shareholder. We said financing activity is the easiest one to identify, only related to party bankers or investors, right? That's all we need to worry about. So therefore, let's look at the cash flow related to the creditor and the stockholder. So eGames issued a common stock for $5,000 cash and paid a cash dividend for $12,000. So therefore, when you issue common stocks for $5,000 cash, that means the cash inflow. Basically, you there's a $5,000 worth of stock equity being sold to the outsider, hence you raise funds $5,000 from equity market, and then you paid the dividend to the existing common stockholders for $12,000. That's cash outflow, right? So therefore, the cash flow from financing activity is actually decreasing for $7,000. So let's look at this example. Which of the following cash transaction would be included in the financing activity section of the statement of cash flow? Sale of the land should be investing activity, right? Payment of dividend, it should be the financing activity because paying dividend is taking care of the equity section of the balance sheet, right? Reduce the equity, right? And then C, purchase of equipment, it should be investing activity. And the payment of salary should be operating activity, right? Okay. So I just want to re-emphasize, here is a payment dividend. Once again, dividend that is received is not going to be the financing activity, it's going to be the operating activities. Okay. So since we actually completed all this adjustment, we find out that we did all this depreciation loss, adjusting the net income to the operating activity net cash flow. We adjusted the non-cash item, we excluding non-operating items, and we adjusting the decreasing and increasing in current assets and current liability section based on grid. Remember, grid we just did. The rule is like this. Current asset and current liability, if it's increased, is decreased, we minus the current asset increase, we plus current asset decrease, we plus current liability increase, and we minus current liability decrease. So if you see increasing current assets, we should minus it. Okay, decreasing the current asset, we plus it. That's right. Increasing prepaid rent. So it's increasing the assets, right? So that's why we so increasing prepaid rent. Yes, we should minus it, right? And then decreasing accounts payable. Decreasing accounts payable. So we should minus it. That's right. Increasing interest payable. Increasing in current liability, we should add it. And decreasing income tax payable. a decrease in current liability. So it's decrease. Okay. So all this are reconciled based on this, right? Okay, so then we're getting an increase in current in cash flow from operating for $50,000, and then we just think about the activity inflow and outflow. Purchasing investment means that we have a cash outflow. Sale means that we have a cash inflow, and so we end up with the outflow of 29,000. And then when it's come to the financing activity, we issue the common stock. That means we have an inflow of $5,000 of cash. We pay the cash dividend for $12,000. That means we have a $7,000 of net cash outflow for the financing activity. And we're adding then 1, 2, 3 steps together. We're getting a $14,000 cash change. And then we're adding the beginning cash of 48,000. Finding the cash balance of the end of year December 31st, 2021 should be $62,000. And we also have a note saying that we also purchased equipment by issuing notes payable. That's not involving cash. And we put it right here. And then so far, you prepared a complete cash flow statement. Good job. Okay. So now we wanted to do something related to the cash analysis, right? Cash analysis is usually related to the liquidity, whether this company can pay the debt or meet the cash demand in a short period of time, in the short term. So we want to use Apple and Alphabet, which is Oracle, mother company of Oracle, or Oracle changed the name to Alphabet. So let's look at this example. First of all, we want to perform financial analysis statement of cash flow. So cash flow ratios often is used to supplement analysis of a company, right? And then we want to substitute cash flow from operations in places of net income. And then when there's a positive cash flow from operation, it's important to the company's survival for the long term. And then so let's look at this example. This is just a section of financial data for the Apple and Alphabet. So there's a net sale and there's net income, there's operating cash flow, there's total assets and the ending. The first ratio we wanted to look at are the return on asset. You should remember this, how to calculate. It equals net income dividing average of assets, right? So therefore, Apple have a 13.9% of return on assets, and Alphabet has a 12.4% of return on assets. And then now we want to introduce a new item called the cash return on assets for Apple and Alphabet. How do we do that? Cash return on assets is equals operating cash flow dividing average of assets. Okay, so therefore, the operating cash flow, if you remember, the Apple is $63,000 and Alphabet is $36,000. So therefore, you can see the cash return on assets for Apple is 18.2% and Alphabet is 22.9%. And then this is something interesting. Cash return on assets measures operating cash flow generated by dollar of assets. Okay, and the cash return on assets can equal the cash flow to sales multiple cash asset turnover. Cash flow to sales is measures operating cash flow generated by each dollar of sales, right? And asset turnover, we learned it before. It means the measure sales revenue generating per dollar of assets, right? Basically, your cash return on assets means that $1 of assets, how much cash I can generate. It equals $1 of sales, how much cash I can generate. Multiple $1 of assets, how many sales I can generate. So the ability of sales transfer to cash sale multiple the ability of assets transferring to sales equals the ability of the asset converting to cash flow. Okay, this is what the deeper meaning of cash return on asset. So let's calculate it. So cash flow to sales for the Apple means $1 of sales. $1 of sales, how much cash I can generate it. So basically it's 27.7% and Alphabet is 39.9% is equal to operating cash flow dividing net sales, right? Okay. So the asset turnover for Apple and Alphabet means that for $1 of asset, how much sales I can generate. So basically, Apple's asset turnover is 0.66 times. Basically, $1 of asset can transfer into 66 cents of the sale for that year, and Alphabet is $1 of asset can be translating into sales for 57 times. So if you multiple these two together, these two number 0.66 multiple 27.7, you should be able to equals to a cash return on the asset. So basically $1 of asset, how much cash I can generate. So which of the following is ratio computed by the dividing operating cash flow by net asset? So cash flow, net operating cash flow dividing assets should equals the cash flow to asset, right? Oh, sales. So sorry. So basically we call the cash flow to sales. $1 of sales, how much cash I generated. Okay. Okay. So chapter 11, I can say some of you guys will feel challenging, but this is the thing I want to help you. First of all, we want to deeply understanding what activity belonging to what is what section of cash flow statement. And then simply is operating cash flow as operating activity cash flow is only related revenue and expenses, right? And investing activity of cash flow is inviting sell and buy long-term assets. And then financing activity of cash flow is involving bank creditor, is involving long-term liability and equity section, right? And then so therefore we've said income statement and balance sheet has its own function in terms of reconcile cash flow statement. For the operating activity, it's all coming from here and several here. So current assets, current liability, right? And then for the investing activity, it's coming from long-term assets, current assets, sorry. Okay, from financing activity, it's coming from long-term liability and equity, right? Okay, so then this chapter, the second lecture is more in depth in understanding how do we prepare in operating activity first, right? So we need 3 steps. First, prepare each one, 1, 2, 3 steps, and then we're adding them up, and then figure out adding the beginning, and then we got the ending, right? So that's it. So the first hard one is operating activity, and we introduced that there's an indirect method and direct method. And direct method we don't talk about. Indirect method is something that you have to know. And indirect method is to adjusting net income to operating activity cash flow, right? So in here we will adjusting we were gonna cover 3 sections. First of all, we wanted to adjusting non-cash expenses. Second, we want adjusting non-operating items. Third one is we're adjusting the current asset and the current liability changes, right? So non-cash expenses, we're talking about, for example, depreciation, amortization, right? And the non-operating activity, we talk about gain and loss, right? And then current liability changes, we said there is a grid that we can draw. So current asset and current liability, the increase, if it's decrease, what do we do, right? So therefore, let me give you the sign of each one. So when we adjusting non-cash expenses, we want to add it back those depreciation and amortization expenses. For non-operating items, we want to minus the gain and plus losses. For the increasing of a current asset, which is the third bullet point, we want to minus the cash flow. For the decreasing of a current asset, we want adding the cash flow. For the increasing of a current liability, we want adding the cash flow. For the decreasing of a current liability, we want to add minus. If you remember all this, you will be accurately generating operating cash flow statement. Okay. And then we want to go back to the financing, the investing and financing activity. Just see whether you are having cash inflow or outflow. It should not be very difficult, right? So whether you're getting cash or you are decreasing cash. And then you will come up with a consolidated, a very good cash flow statement. And then we introduce the cash return, cash on assets, right? Cash flows on assets is equals cash dividing the sales multiple assets sales, right? So basically, we want to say that this is asset turnover ratio multiple the return on sale, cash return on sales, and then equals the cash return on assets, those ratios, right? So we can understanding some sort of cash analysis. Cash flow to sales. Okay. Okay. So therefore, I believe this is not important. This is very important. Okay. Although you will not be examined, but this is a critical a chapter to tie income statement and balance sheet together, generating a correct cash flow statement. Okay. This is an interesting chapter. It's more challenging and hard to understand here, but I will go through the exercise questions with you in class. So I will see you in the class and have a good weekend.